Hey guys, my name's Narai, and today we're going to be taking a look at the International Monetary Fund and the Greek economic crisis. So for the outline of my presentation, first we're going to look at what is the International Monetary Fund, then we'll do a quick background on the 2008 economic crisis, a little brief background on Greece, then we'll take a look at Greece and the IMF, and then we're going to see what the impact was. So what is the International Monetary Fund? The International Monetary Fund is an organization that focuses on macroeconomic issues with the primary goal of promoting international monetary cooperation. They provide a framework that allows for collaboration between the organization and a country experiencing monetary issues. The IMF is comprised of 191 members who collectively work together with three critical missions that they want to achieve. One, they want to further international monetary cooperation. Two, they want to encourage trade expansion and economic growth. And three, they want to discourage any policies that have the potential to harm prosperity. So, what is the 2008 economic crisis? Well, the 2008 global financial crisis started out in the United States, and it's a result of banks and lenders continually making large volumes of risky housing loans. In the years leading up, the conditions of the economy were very favorable in the United States and other countries. There was a strong growth and stable rates of inflation, and as a result, housing prices were strong. It was assumed that these prices would continue to grow, which resulted in an increase in borrowing to build houses. But instead, what happened was that people began to default on their mortgages, and since the lending was incredibly lax, there was a lot of economic issues. Due to interconnected economies, the impacts were felt globally. So, a little brief background on Greece. Prior to 2008, Greece had already been in a state of mass debt. In 2004, their national debt amounted to nearly 98% of their GDP. They were also facing issues with their systems of taxation because they were ineffective, and along with that, and their social security benefits were inflated, and they had a bonus system that was excessive. They were further driven into a recession due to decades worth of negative credit in a financial market where their debts were only continuing to rack up. Greece and the IMF. Greece was facing such extreme amounts of financial debt that it had come to the point where they had lost all credibility in borrowing and repayments of loans. To assist Greece and their economic crisis, the European Commission, the European Central Bank, and the International Monetary Fund came together and launched a plan in May of 2010. The IMF agreed to provide Greece with a loan totaling 110 billion euros, 80 billion of which was provided through bilateral loans. The payments would be dispensed in 12 installments over the period of 36 months, so long as Greece could uphold conditions of the loan. The the European Commission, European Central Bank, and International Monetary Fund would be responsible in overseeing this process. In the first stage of this program, the IMF agreed to fund Greece with 30 billion euros during their first aid program. They were given to them under a standby agreement, also known as an SBA. This is where the money would be released in installments in exchange for the Greek government upholding the following commitments. They would need to tighten their domestic demands, reduce public expenditures, and restructure and privatize their labor market. To accomplish these goals, there would need to be reforms in fiscal consolidations, structural reform, and an increased support in their financial sector. So long as these goals continue to be met, as long as these goals continue to be met, money would be could be continued to be released to aid Greece. In regards to fiscal consolidation, reforms were made through increasing taxation and reducing their expenditures. In order to support the financial sector, the Financial Stability Fund was created. The purpose of the FSF was for commercial banks to have the ability to acquire shares in banks and over time convert them into ordinary stocks. 10 billion euros were allocated for this effort, yet by the start of 2011, no single commercial bank had yet to receive any funds for their effort. Through many reviews, it appeared as though Greece was continuing to head in the appropriate direction, but it would soon come to light that the situation was much more dire than initially assumed. The IMF would only end up funding just over 20 billion rather than the original 30 billion. And in June of 2011, Greece would adopt a new policy surrounding the health sector, public administration, and in the energy sector, to name a few, which garnered them positive assessments from the organizations involved. A second program was launched in 2012. The intentions of this one was to aid in strengthening the economy by fighting the unemployment, and there was hopes of having confidence for investors be restored. It was at this point the severity of the economic crisis in Greece really came to light. The new government of Greece canceled the standby agreement and put in a request for 28 billion euros under the extended fund facility. With the EFF, the IMF places higher austerity measures, which meant that Greece would need to become stricter with their expenditures. Following the EFF approach, Greece had to tighten up their spending even more. They did this by increasing taxation, and they worked to improve their tax administration. They also enforced a retirement age of 65 to limit those who wished to retire early. In the health sector, there was a reduction in health services. So, what was the impact? To this day, despite the many attempts made to strengthen the Greek economy, the country is still facing issues surrounding their financial stability. As of 2017, their debt is higher than at the beginning of the crisis of 2008. Nearly 1 in 5 of their citizens are currently unemployed. Issues further arose when Greece became the first country with an advanced economy to miss a repayment to the IMF. There have been criticisms directed towards the International Monetary Fund because they proceeded to aid in a country where there were many misgivings surrounding the economy. Greece was also the first time the IMF partnered with another organization to co-finance a country. Though this is not the first time the IMF has had a bilateral agreement with a separate organization. It was the first time in which that organization played an instrumental role in creating and monitoring the program. In the reading, The Global Diffusion of Public Policies, the authors raise multiple concerns with the IMF that are applicable to this crisis. They point out that the conditions the IMF attempts to enforce have questionable credibility. This is due to the fact that they often do not reach their intended effects. There has been a known history of non-compliance with their programs. This isn't to say there was not an effort made on behalf of the Greeks, nor the IMF and other organizations involved, but there were many factors not considered in the beginning that led to the program not achieving its desired results. In conclusion, the economic crisis in Greece started long before 2008's global financial crisis, though it was fueled by that. There were large efforts made by many organizations involved in Greece's economy, but there were many bumps in the road that resulted in plans not being as successful as they could have been. And that's